So, impact
hmm
investing, what does it mean to Web? Because we hear a lot about people investing for impact, and people have different ideas about that. And you're having done it for such a long time, be kind of an interesting starting point.
Yeah. Well, I mean, in a way, we talk about having done impact before it was ever called impact. So the strategy we run was originally called the Industries of the Future Fund. If you remember, Mike, so I think you probably knew it
I
then at the time.
I do.
Um, and we never talked about impact, but we always talked about investing in companies where the product or the service was a solution to a sustainability challenge. And so we were investing in companies that were providing solutions, and therefore the product or service has a positive impact on society or the environment. And that was the original conception because we saw those as being growth markets, markets where you're producing the products and services we need to buy more of in a world where you transition towards a zero carbon and more sustainable economy.
And having done it for the period that you have, how many sort of sectors, industries, areas have you seen become less relevant as a future, and how many new entrants have you seen?
I think over 20 years we've seen it grow. It's more that markets have developed, and sometimes more that markets have developed and they've kind of done their thing, if you like, or they've had their impact, and then we've gone through it. So we've always operated with a mix of social and environmental themes. So we have 9 themes which cross cleaner energy, resource efficiency, water and sustainable transport, and environmental services, but also health, education, well-being, and safety. As all of those are areas where you can find companies where there's a lockstep relationship between their unit sales growth and a positive impact. But those 9 themes haven't really changed in the last 20 years. But beneath that, you've seen sort of technologies and end markets come and go. And the example I use sometimes is LED lighting, where we now that we're more sophisticated about thinking about impact, we're looking about how that impact is additional or positive compared to a baseline. So if you think about LED lighting 10 years ago, when we were investing in companies which provided LED lighting, those products were displacing incandescent lighting and providing lighting at much lower energy usage and much greater efficiency, and therefore lower carbon footprint than the products they were displacing in incandescent lighting. Today, the market is now LED lighting. It's not, there's no improvement compared to the baseline. That is just the market. So we're always looking for markets and companies which are providing products and services which are generating positive improvement in the world. And to have that, you have to have a kind of context or a comparison to what would be business as usual.
So, in a way, that's a really good example of theory of change, which is the change has actually happened because you can't now go and buy your old Osram 60 watt
Yeah,
because
yeah.
that's done. And you can almost tick that one off on your list of, the theory of change was to achieve this. Now that's established technology rather than something that's an exciting new thing or a developing new thing.
Yeah, absolutely. And I mean, there's a kind of impact element of that, saying, well, that theory of change from an impact perspective has worked its way through. There's also kind of an investment perspective on that as well, in that that market has gone through its cycle of development, the kind of technology S curve, if you like, that technology has been adopted, it's seen its rapid growth phase, and it's now moving into a more normalized growth phase.
So when I'm going to mention it, SDR came along.
Yeah.
The idea of impact, the original outline from the FCA was much more around primary rather than secondary markets, which interestingly they needed to change because there wasn't really anyone who was going to get that label. How do
Yeah.
you see the impact piece in terms of secondary markets as against primary markets? I don't think there's any doubt that primary markets can be more easily measured in terms of impact, but they are also much too difficult to fit into the advice process as well as the investment management process.
Yeah, yeah. This has been this long-running debate, and SDR, or the Sustainability Disclosure Regime, is really helpful because it kind of puts to rest, in a sense, or sort of authorizes impact in across asset classes, and kind of confirms that it's right to exist. So what I described originally was how we've always invested in companies where the product or service has a positive impact. So what I just talked about was how we find companies that are essentially the impact economy, where those companies, there's a lockstep relationship between their unit sales growth and a positive impact. So there's no doubt that we were investing in impact. But is that the same as being an impact investor, or are we having an impact through our investment? I think the controversy is whether through buying shares on a secondary market, so we're buying from other investors as opposed to giving the company new money, whether that still has an impact. We'd argue that it does, but there was a need through the SDR process to kind of formalize that and show that in a systematic way, and also in a way that can be explicitly measured and reported against. Now, there are two aspects of what we call the investor contribution. So we talk about impact coming from two different perspectives. One is the underlying impact of the companies we're investing in. And secondly is what we call our investor contribution, as in the difference it makes that it's WHEB making that investment as opposed to any old other investor who has no intention to have a positive impact or doesn't care about it, but is just investing in that company because it happens to be there. Now we can make that investor contribution in a more visible way through our engagement, through how we manage our investments over the long term and target change and talk to and make a two-way conversation with company management to promote change, either to accelerate positive impact, reduce any negative impacts, or manage the company well so it is successful and has that positive impact. So we have a very structured approach now to our engagement that allows us to target our engagement around positive impact in a way that is also aligned with the company's success, but also then allows us to measure it in the same way that we measure the underlying impact that companies have. And so it's only that kind of investor contribution that counts in the SDR process. But I'd argue that actually it doesn't matter really whether you can measure it or not. And when we wrote our original paper on impact investing, we talked about the importance of the systemic nature of investment. And the fact that you're a secondary market investor means that you're part of the system of investing. And on today of all days, because this is the day after Liverpool won the Premier League, I wanted to crowbar in a kind of footballing analogy. But if you go to Anfield and you're in the crowd, now Anfield is famously noisy, the crowd sings very loudly, and everyone in that crowd feels they're a part of it. But if you took one person out of that crowd and they weren't involved, then you wouldn't notice the difference. But it collectively takes the whole crowd together to make the noise in the stadium and to sing together in the stadium and to support the team. And that has an impact. So that each individual person in there has an impact, although you can't measure and identify each individual person's contribution, if that makes sense. That's the kind of system that operates in a crowd. And the same kind of effect is there in a financial market when you're operating in a stock exchange, or as an individual investor. When you are investing in one way, you crowd in other investments.
It's also a point that somebody made, somebody quite smart made, which is you can't have an impact if you don't make any money. Because if you're trying to make change, you're not going to do it if everyone's losing money. And there's a benefit in being an investor if you are making money, because it encourages more, which then brings more people to become part of the tribe.
Yeah, and we've talked a lot over the years at WHEB. We've talked a lot about trying to build a movement, and that sort of idea of how we are here because we want to affect systemic change in financial markets. We want to see more investment capital directed towards the industries we need, investment for good, and we can't do that on our own. And so we want to see others coming alongside us. So we've always welcomed kind of competition. We've always welcomed our peers. We've always welcomed others coming into the space, sometimes copying what we do, sometimes learning and doing some things better, perhaps. But we want to learn from our peers, and we want to also bring in others into the space. So when we were quite early with the SDR label, we were the first listed equities fund to achieve an SDR label, and the industry was finding it quite difficult. And rather than us just sort of thumbing our noses at everybody else who hadn't managed to get an SDR label, we ran webinars, we ran teach-ins, we sort of did one-to-one calls with our competition to help them get through the process, because there's no benefit to WHEB being the only fund with an SDR label, because then the whole market won't work.
The last question, which was what do you think the future looks like for managers like WHEB? And turning that round slightly, do you think with the recent development with Foresight and everything that WHEB could start again?
I mean, I have thought a number of times, and I don't know that it would be very difficult, and it is very difficult. It was difficult 12 years ago to get a new business off the ground from scratch. We spent, I don't know how long, going around talking to potential clients who'd say, come back when you're bigger and come back when you're older. There's this sort of chicken and egg saying, well, we're not going to get bigger unless you help us get bigger. Somebody's got to help you get there. And that problem has not gone away. That problem has only got more extreme as the kind of our client side of market has consolidated. So the clients that we face have got larger, which means that they're come back when you get bigger. What they mean by bigger is a bigger number than it was 12 or 14 years ago. So that's a challenge. And alongside that, especially in this market around sustainability, the resourcing challenges of being able to both contribute at the policy level, which is really important in the market. And if you're a sustainable investor and an impact investor, you can't just operate in a bubble. You've got to be engaged at a policy level and at a market formation level, and that's really a big resource requirement. And so doing that on your own from scratch, because it also doesn't generate any revenue particularly, but it kind of supports the whole ecosystem. And I think now that impact has become better understood, and it's better understood to do it properly. It's not a kind of it's a resource heavy occupation, if you like. And so again, the kind of cost base that you need to put in place on day one, if you're setting up a new fund management business, is quite significant at the point in time when you have no revenue. So unless you can start a new WHEB at a running start where you've already got money to manage and revenue to support that, it's going to be a real challenge, or it needs backers who are really far-sighted and prepared to sit for the longer term.
Yes, because it is the old cliche, you can't have a job without a reference, and you can't get a reference without a job. And I can remember conversations when you started where people were saying, come back when you've got to 40 million in assets under management or something similar, and that number has now increased significantly. And to get there is, even, as you say, even more difficult, because the people who are investing, particularly the institutions and the NPS providers, etc., because the NPSs have got bigger, the ticket size changes, and so it becomes increasingly difficult.
But I think that, I mean, that you talked about the combination with Foresight. That the other thing is the ability to ride out market cycles. Because if you're doing something like impact, you're doing something that's definably very different. We saw a sort of rush into this space between 2017 and 2022. We saw a lot of people who were kind of didn't really know, who were sort of latterly like tourists coming into the space in a period when it was very fashionable, who've left the space just as quickly when it's become less fashionable. And you need to have the ability to be resilient and constant in your commitment to this space through cycle and for the longer term, because this is a longer term investment activity. It requires you to be an investor and not a trader, and therefore to be able to see through market cycles and to take that longer view. And that means staying constant to it. And being part of something like Foresight, you've got a bigger balance sheet, you've got broader capability in impact, but across different asset classes. That gives that real sort of ability to be resilient through cycle, which I think over the long term will put one in a much stronger position.
Good. I think that's enough of us burbling on. That's been great. Thank you very much.
Thank you, Mike. Good to speak to you.